I think it's very possible that one of the reasons why gold is in this massive bull market, other than the fact that real interest rates are falling, if you look at money market rates versus in real terms versus inflation, adjusted for inflation, is the fact that they're going to perhaps monetize gold by declaring it worth $3,000 an ounce, $5,000 an ounce, maybe much higher than that, much more, maybe $140,000 an ounce, and pay off our entire debt by printing money. Now, that's a very extreme case. I don't think it's going to happen. But could they revalue gold to a fair market value that's north of $3,000 an ounce? Yes, I think they could do that, and that would create a whole heck of a lot of inflation.
Gold prices surged to an all-time high of $2,940 per ounce last Thursday, pushing its market capitalization above $20 trillion for the first time. This remarkable rally has been fueled by growing trade tensions between the U.S. and Europe, raising concerns about a global economic slowdown and increasing demand for safe haven assets. However, beyond traditional drivers, there is speculation that a potential revaluation of America's gold reserves could further propel prices higher. The United States has the largest gold reserves, totaling 8,133 metric tons, but its official valuation has been stuck at $42 per ounce since 1973, amounting to only $11 billion. Recent interest in these reserves, especially at Fort Knox, has grown. While Treasury Secretary Scott Bessent ruled out revaluing gold prices to market prices, discussions on the implications continue. Some analysts, including MichaelPento, president and founder of Pento Portfolio Strategies, have speculated on more extreme scenarios in which gold could be revalued to as much as $140,000 per ounce to eliminate U.S. debt. Despite the recent highs, gold prices have experienced some pullback, dropping to a two-week low of around $2,880 amid a modest rebound in U.S. Treasury bond yields and a strengthening U.S. dollar. Additionally, a generally upbeat tone in equity markets has weighed on the precious metal. However, ongoing trade policy uncertainty, mainly concerning U.S. tariff strategies, keeps investors cautious. Pento argues that the most plausible outcome is a continued strong uptrend in gold, driven by falling real interest rates and persistent economic uncertainty. Whether or not an official revaluation occurs, gold's role as a critical monetary asset appears to be growing. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Bessent was on TV today, and he was asked this question. Well, first of all, there was a couple of rumors. Gold is very close to $3,000 an ounce, an all-time record high. And I own some in my portfolio, and of course, I advocate that everyone own 5% physical gold in their own possession. But I asked myself, why is gold in this very extended bull market? I think it's one of the best bull markets in history in gold, and I think it's just getting started. But I asked myself this question: why is that so? Because you think about what's going on. Well, interest rates have been rising on the long end of the yield curve, so nominal rates are rising. That's normally not great for gold. The dollar has been in a huge bull market. That's usually not great for gold. Peace is breaking out supposedly all over the world. That's Ukraine, Russia, and Gaza. That's supposedly not so great for gold. So what's the reason? What's the rationale? And of course, Bitcoin has been stealing a lot of gold's thunder. What's the rationale? So there's a couple of rumors out there. One is that they were going to audit the gold in Fort Knox. And then Bessent was on TV today saying that he can guarantee you that all the gold is there. And it isn't gold-plated tungsten. He didn't say that, but I'm adding that. So that was one possibility that was out there, that real interest rates are falling because of precisely what we just talked about, Andy. We just said that the Fed lowered interest rates by 100 basis points since September 18th of 2024. They started with a panic 50 basis point reduction. And at the same time, inflation's going higher. And if your interest rates on T-bills and in the money markets is static or going lower, and inflation is going higher, then what is happening with real interest rates? They are falling. And that's always been rocket fuel for gold. So that is probably what's happening. Now, there's other, and I remember the other thing you were alluding to. We were going to monetize gold. I want to talk about this for a second. So the Treasury has supposedly 261 million ounces of gold. valued at $42 an ounce. And if they revalue this gold, it would be like, I think, $750 billion. Now, the gold is the gold. It's there. This is an accounting trick from Treasury. And they can say it's $0 an ounce or $1 million an ounce. The market value of this gold is $750 billion, right? We agree with that, Andy? You're with me so far? Here's where I think Bessent and whoever's talking about this falls off the rails. He's talking about monetizing gold. Does that mean you're going to sell your gold and raise $750 billion? I think that would be a terrible move to sell all the Treasury's gold. But they want to do something else, which I think is kind of funky a little bit. They want to monetize this gold by revaluing and say, okay, gold is now at a market price. We're going to value it on our balance sheet, $750 billion. But then magically, that's going to allow the Fed to repo the Treasury's gold and put on the Treasury general account by a couple of keystrokes, making it $750 billion, which the Treasury can then use to pay off debt. That's where I think, just because you revalue your asset doesn't mean you get to magically declare you can create $750 billion and pay off debt and still believe and behave like you have 261 million ounces of gold. But Bessent said this morning, he said, that's not what I meant. I didn't mean by monetizing Treasury assets that we were going to revalue gold. Well, what did you mean? I don't know why. He was on a Bloomberg interview, just to be specific. I don't know why they didn't ask him, well, what the heck did you mean by monetizing these assets?
New inflation data set for release on Friday is expected to show a slowdown in the January personal consumption expenditures price index. However, the Federal Reserve remains cautious, with policymakers likely to hold interest rates steady at their next meeting as they assess inflation trends and the impact of Trump administration policies, including tariffs and immigration measures. Markets anticipate at least 2 rate cuts this year, with approximately 55 basis points of easing priced in for 2025. Investors are also closely watching scheduled speeches from Federal Reserve officials for further insights into the future of U.S. monetary policy. Meanwhile, President Donald Trump confirmed that his proposed tariffs on imports from Mexico and Canada will take effect on March 4th, alongside an additional 10% tariff on Chinese goods. MichaelPento notes that the 2% inflation target is increasingly scrutinized, as inflation has consistently exceeded this benchmark, eroding middle-class purchasing power. While deflation is often viewed negatively, it can enhance productivity and reduce costs. Instead, current policies have contributed to asset inflation, particularly in real estate, where institutional investors like Blackstone have amassed significant housing inventories, driving up home prices and rents. As economic conditions evolve, the debate over monetary policy and its impact on inflation remains central to market dynamics and financial stability. Let's get back to the interview.
I think they have and I might be wrong, I think they have 400 PhD accountants, PhD doctorates at the Federal Reserve. 400 people for what? To be data dependent? It's absolutely silly, right? So this is what I would do. If I had my draw, I'm king. You made me king for the day. I would say, okay. So the base money supply, high-powered money, which is what the government does control, okay? So you think about cash and Fed credit. I'm going to make that grow by 2% every year to match population growth plus productivity growth, which is commensurate with GDP growth. 2%. No more and no less, no matter what. So that's the base money supply. And then I'm going to let that savings, that money, that real high-powered base money supply, that will be in the banking system, I'll let that rate float vis-a-vis the demand for those loans that are available in circulation, money in circulation versus demand for credit. And there you have a market rate based on a real money supply that's never going to be inflationary. Andy, as you know, I'm not going to reveal anything to you. The Fed's balance sheet was $800 billion prior to the global financial crisis, which was 2000. December of 2007 was when the recession officially began. And it went to $9 trillion in 2022, from below $1 trillion to $9 trillion. And the amount of reserves, bank reserves, which this is bank credit, and there's also, I would, Andy, can you help me get on the panel that asks Jerome Powell questions at the annual Humphrey Hawkins testimony? I would ask questions like, why do we have a 2% inflation target? Well, and you've missed it for 4 years. I would ask some questions like, how the heck did we get from $60 billion in reserves for banks to $4 trillion in reserves? And why the heck are they still above $3 trillion? And why are you only draining them slowly? Why are you talking about stopping that now because of a debt ceiling debate? Why are you destroying this country? This country's middle class has been eviscerated because of the inflation that you created. Andy, there's nothing wrong with disinflation. There's nothing wrong with a little bit of deflation. We've had that in this country before. And it was our shining hour. There's nothing wrong. In fact, deflation is a natural byproduct of being productive. You're more productive. You can sell more whatever widgets, and you can lower the cost, and more people have widgets. That's the natural. That's the way the economy should function. This 2% malarkey, which became, we have 20% year-over-year home price growth appreciation for year after year. And then we have nice, benevolent, altruistic companies like Blackstone buying thousands and thousands of homes and then renting them out to the poor, impoverished middle class. Doing us a favor. They actually were on TV saying what a favor they're doing. Supplying more homes and more roofs over the heads of the population. It's nonsense and it's disgusting, and this has to stop. I'm hoping I'm hoping our new president realizes it and puts an end to it. I have my doubts, but he's the only one I think is even remotely possible of doing it because he's the only one even talking about it.
With markets closely monitoring policy decisions, interest rates, and geopolitical developments, the potential impact on inflation, asset prices, and monetary stability remains a key concern for investors. Whether gold sees an official revaluation or remains driven by market forces, its significance as a financial safeguard is increasingly evident. Likewise, ongoing debates around inflation targets and economic policies highlight the challenges of maintaining stability while balancing growth. What do you think about the possibility of gold revaluation and its impact on the financial system? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.